Can everybody hear me?
Yes.
All right. Well, welcome everyone. For those of you who don't know me, which I don't think there's very many people here who don't, I'm Brett Bunger. I'm one of the principals of Legacy Capital Group, as well as React Investment Solutions. And I'd like to welcome you here tonight. We've got a very special guest, Dan Kraniger from NorthCoast Asset Management, one of our new managers on the React platform. So we're really excited to listen to Dan and hear his thoughts on the market and how to attack this rather difficult environment. And I wanted to start off with a few thoughts on the market. So as many of you know who are clients, it's been a little bit of a frustrating year this year so far. The overall market, as measured by the S&P, is up marginally this year. But when we're getting tactical with things, where we're trying to pick stocks, we're trying to manage risk, it's been a much more difficult endeavor, and I want to talk to you a little bit about why we think that is. That wasn't good. Did I do something wrong there? This is one of the difficulties we've been having. Perfect. Okay. So this market, when I talk to people and from what we remember, we've been doing this for a while, reminds me personally a lot of the late 90s. And why do I say that? So the chart that you see here breaks up the S&P 500, and I would imagine most of you are familiar with the S&P 500. So 500 basically biggest companies in the United States. What this chart does is it breaks that market, the 500 companies, up into groups of 50 companies. So there's 10 groups of 50 companies here. And on the bottom here, we're going from largest. So now we're talking about the Apples, the Amazons, the Googles of the world, to the smallest. So some of the companies, the smaller companies in the S&P would be like Chesapeake Energy, Pitney Bowes, companies like that. And what this shows you is what the performance is for the largest and the smallest companies. And as you'll note pretty quickly, there's quite a disparity. You can see that, and this is the 500 largest companies in the universe, mind you. The smaller ones of the 500 are off almost 20% on the year, while the larger ones are up 8.25%. Said another way, when we look at the broad markets, now we're looking at the Wilshire 3000, or the Russell 3000, Now we're looking at 3,000 companies across a very broad spectrum. And you can see the performance on a year-to-date basis for the top 500 of the 3,000 companies is about 2.5%, right at the S&P performance. Whereas the bottom 2,500 companies are off a little over 4% on the year. So what does that tell us? Well, it tells us that the market is very narrow. There's a few companies, and it skews to the very large companies that are doing quite well, and the majority of the market is struggling. And there's a lot of reasons that could be. Monetary policy might be a reason for that. We've had a lot of federal bank intervention, central bank intervention over the last 4 or 5 years. Those dollars tend to flow to the larger companies over the smaller companies. That may create some of this bias. I also call it now we're going to look at, what I want to do now is compare to I want to compare it to the late 90s. So, the question is, have we ever seen this before? So this is what was going on, and these slides we actually created in 2000. So these are 15-year-old slides that I pulled out today, just to show you what things were looking like in the late 90s. So you see that long-term average in the stock market of 11.2%. That was 1926 through about 2000 for the S&P. But at that point, when we were in that bear market of the bull market of the 90s, we were up about 19.5% per year over the trailing 10 years. extraordinary returns. The last 5 years were 24%, and the 3-year average was a little over 20. Things were ripping. It was incredible. But when you go to the broader market, it's not a dissimilar story from the one that I was describing currently. So when you look at the percentage of stocks in 1999, even though those averages were that extraordinary, you look at the percentage of stocks that were down in that period of time. You look at the New York Stock Exchange, 61% of the stocks were off, negative. Even though the market's up in that particular year 25-30%, the S&P 54%, the NASDAQ, which did actually 80% in that particular year in 99, half the stocks were off, as well as the Russell 2000, which is a measure of the broader stock market, small stocks, a little over half the stocks were off. So that's kind of what we're dealing with today. It's not an excuse, but it's a reality. It's a reality of the market. It's a narrow market, and one that I would contend is telling us something. And I think it's telling us that there's risk out there. And I think that that's the thing that is lost when we've had, you know, a period of time where we've had 4, 5, 6 years where anytime the market swoons, the central banks come in, they pump money to the equation, they smooth things out, and they make everything all right for everyone. And I think we have to be cognizant as investors, as investment professionals, of measuring risk, of not losing sight of the fact that there is risk out there. And we need to look for good risk-reward relationships in the market. And that's exactly why Dan's here tonight, is to talk to us about their methodology, how they assess the risk for per unit of reward in a given market environment. So I'd like to invite Dan up here. I'd like to read you his bio real quick. So Dan's the Chief Executive Officer and President of NorthCoast Asset Management. Dan was previously a Senior Vice President at GE Asset Management, company that oversaw about $2.5 billion of assets. His responsibility was for the private client group at GE. Dan's a graduate of Villanova University in Philadelphia. So I'd like to welcome Dan.
All right, guys. Quite a lead-in here. Quite a lead-in. I am feeling a little depressed. And you served me a double scotch now, Brent. So we'll see where this goes, I guess. Thank you all for coming. Thanks for all hanging out with me for a little bit. The topic I was handed before this double scotch was seeking risk-adjusted returns in today's equity market. I don't even know what half of those words really mean, so off we go here. So before we start, because this is a heady topic, and we've had a little drink, we've had a little food, why don't we start with a little brain teaser? And that brain teaser is on your desk in this little card. So if everyone could pick up that card, let's talk a little bit about this silly sentence. Everyone got a card? Okay, what I want you to try to do in the next 30 seconds is I want you to try to memorize that card. Try to memorize what that card says. If you don't have one, I can hand out some more. Try to memorize that in 30 seconds. Look up when you got the answer. Anyone else need one? Okay, I see a few eyeballs. You all got it memorized. Now what I want you to do, since you're so familiar with it, is what I want you to do is look at that sentence and just count. Just count the number of F's. Just count the number of F's you see in that sentence. And look up when you got the answer. Okay, how many of you got the card with one F? Raise your hand. 2 F's? Anyone with 3 F's? Raise them high. Raise them high. Anyone got 4 F's? Who's got the 5? And anyone with the 6 F's? With a 6 F here. Okay, just double check. Count the number of Fs, because I want you to be very certain with your answer. Count the number of Fs. Okay, who's got the one with every two? We're out there. I don't think I handled that. Any more 3 Fs? Great, 3 still. 4s? Raise them up high. Thank you, Drew. 5s? Who's got 6? Okay, so this silly sentence, what I want you to do now is look at that card and just look at the word of. Just look at the word of. What you'll find is there's actually 6 Fs on that card. What's happening is your brain is playing a little trick on you. Your brain phonetically sees the word of and registers a V and not the F. So it's playing a little trick on you. This is something I saw first 20 years ago and I hang on to my whole life because it helps me understand about looking for blind spots. Because your brain plays tricks on you all the time. And I got bad news for you because your brain doesn't just play silly little tricks like this on you. Your brain also has an enormous set of behavioral biases. We all have behavioral biases. We all see the world through a lens. And when you're investing, these are the big 3. I'm just going to bring up 3. There's probably about 25 I could bring up, but I'll bring up 3. Bias number 1 is recency. This is something that just happened. It's probably just going to happen again. This is the guy who comes up to you and says, hey, on August 26th, I bought that low. I put money in, I'm up 10%. I can't wait for the next decline in the stock market because I'm going to put the mother load in. I'm going to go for it. The next guy is the hindsight guy. This is the guy, of course, can tell you everything that just happened. This is the guy who says, hey, forget about the dip. Don't buy the dip. Why didn't you just go buy Amazon? Everyone knows you could have bought Amazon. They own the web, big web business, big cloud business. They're bigger than Walmart and Target combined. Of course you buy Amazon. It's up 100% this year. Who cares that it has a PE of 950? Who cares? And then the privacy guy. The privacy guy, these are things that leave such scars you never forget. It happened to you first. And they affect everything you now do going forward is what happened to you first. So this is the guy in 1999 who said, whoa, I'm not buying Amazon. I bought Qualcomm. I'm still bleeding from my eyeballs. Qualcomm. I bought Sun Microsystems. I'm down 85%. My 401k has never come back.
Look at Portal.
So what's cool about this stuff is we all know this exists, but now with science, we can actually look at the brain. We can look at the brain through MRIs and see what happens during certain risk-reward decision-making processes. We can actually see real time what's happening in response to things. So this is a snapshot of that 3-pound thing we call brain. This is your brain. Now I'm going to show you what happens when your brain has stimulus associated with stocks. This is what happens. You see how that brain shrinks? You see how that brain becomes a beast of emotion and bias and tricks? I call this Homer brain. And we all have Homer brain because it hits us all the time. The problem with Homer brain is it costs a lot of money. It costs a lot of money. Dalbar did a cool study. Dalbar for 20 years measured a mutual fund share class. And this mutual fund share class was up 8.2% for 20 years. 8.2% for 20 years. That's a lot of money. And what they then did is measured the shareholders' actual buys and sells. What the shareholder actually got. And what they found is the shareholders of those funds made 3.5%. Now, how does that happen? You say, that makes no sense. Mutual funds like this goes up. How'd they get 3.5%? What happens is they're selling at short lows and buying at short highs. They get excited. They get into it. This is going to the moon. They're going to take over the world. So this thing sucks. I'm getting out of it. I never want to see it again. And they do that time and time and time again. And the funny thing, Fidelity just put out a cool study 3 months ago. Fidelity looked at their best performing client base for the last 10 years. Men, women, wealthy, poor, executive MBAs, no MBAs, high school grad. They looked at a lot of different characteristics of what made the most successful investor at Fidelity the last 10 years in their retail branches. And you know what the class was?
People in coma.
People People who are dead. That is awesome. Diane, major bucks to you. That is awesome. People who are dead outperformed. They were the top decile. That's insane, right? That's insane.
Like Michael Jackson.
So May article, go take a look. It's a crazy read. So we have met the enemy. This is the old Pogo cartoon. We have met the enemy. It is us. We are biased, we are emotional, and we have brains that play tricks on us like that silly little card. The funny thing is everything that makes us interesting as humans, our joys, our pains, our fears, our loves, all that crap is wired wrong when you're approaching the financial markets. And it's not just retail people. It's institutional people too. 86% of money managers with an equity mandate lost to the S&P 514. They lost to the tune of 89% of them for the 5-year period ending 14, and only 18% of them won in the last 10 years. Now, that's pretty pathetic, right? So what is the S&P 500? The S&P 500 for me is not a benchmark, it's not an index, it's a model. It's a model. All it does is come to work every single day and buy the 500 biggest companies. That's all it does. It doesn't care who's president, it doesn't get in a fight with a spouse, it doesn't have a paycheck on the line when it makes a decision, it doesn't have any of those silly things. All it does every single day is come to work and buy the 500 big companies. It's a model. And this little simple model beats almost all of my competition consistently. Simple actuarial models consistently implemented beat human experts almost in any field. In fact, this is now about 4 months ago. Wall Street Journal had an article. A programmer walked up to 10 universities and said, okay, admissions director, I want you to tell me how a student's going to do well. How do you know a student's going to perform well at this university? Every single university admissions director said 2 things. If the student has a pretty good high school GPA, the student has a pretty good SAT score, they're going to perform pretty well at this college, university. Programmer said, thank you, that's a 2-factor model. I'll program a 2-factor model. Let's go head to head. Let's compete, let's take the freshman class, and we'll predict senior year GPAs. The only difference is you can interview every single student, and all I'll do is take GPA and SAT score and we'll predict. And what do you think happened? In every case, 10 for 10, the simple, stupid model based on 2 factors outperformed human experts. And what do they attribute that to? They attribute that to bias and emotion. Because what happens is Billy walks in, and Billy's got a 4.9 high school GPA. He's got 2,200 on this new SAT. But he walks in, he's got long hair. He's got an earring in, Metallica t-shirt, ripped jeans. Nah, I don't care about GPA and SAT anymore. Billy's not going to make it. Sally walks in, nice hair, got the university shirt on, but she's got a 2.1 and a 1,400. That doesn't matter, I think she has something here. That's what happens, and it happens in every walk of life. This whole movie Moneyball, which is near and dear to your guys' heart, that was based on a single-factor model. Billy Bean, built a baseball team on base percentage. Single-factor models consistently applied beat human experts. So, for me, what I want to talk about today is the 3 things you've got to concern. These are the 3 big rules. If you're approaching the market, these are the 3 things you have to care about. 1 is markets change, right? Stupid, right? Avoid big loss, and no one knows the future. First off, on markets change, people talk about after inflation, I'm going to retire, I'm going to make 7.58%. That really is a combination of bull market years and bear market years. If you're the lucky guy who retires in 1982, you're happy as hell. If you retired in 1966 or 2000, you're working at McDonald's again. This just didn't work out. The only way you get that average is a 40-year. You have to have a 40-year time frame. Now, how many retirees have a 40-year time frame? That's insane. You have your retirement. You don't have the average retirement. Markets change. Be aware that markets change. Second is, this is basic math. You lose 8% of your portfolio, you got to make 8.7 to get back the whole. $1 million worth 920,000, you got to make 8.7 of 920,000 to get back to $1 million. You drop 33%, like many of you probably did. You're going to make 50%. You lose 50, you got to make 100%. If you're digging yourself holes, you never make money. You never make money. You're always digging it back out. So you've got to avoid loss. And then finally, no one knows the future. This is a great book on the subject called The Fortune Sellers. It goes back to the Oracle of Delphi, when they used to walk up and say, what crop should I plant? What my future holds? And they used to spill animal bones on a table, read them, and tell you what's going to happen next. And that is no different from an analyst report coming out of Goldman Sachs today. It's the exact same. It's animal bones on a table. This book tracks meteorology, demographic announcements, technology trends, economic, stock market. All these experts are right less than a coin flip. No one knows the future. Even though all of us in our emotionally biased, mixed up worlds all want to know the future, the simple fact is no one does. So, I'm at the halfway point. You still with me?
Yeah.
All right, so what we've learned so far. Brain plays tricks on us. We're emotional entities. Simple models outperform human experts in every field of play. I could go on to wine enthusiasts. When you measure, the soil and you measure the rainy days and the sunny days is a better predictor than the experts. You can go to any field. And I've shown that I believe there's 3 simple ways to approach the market. So now I'm going to tell you how to make money. Because you can take these rules and now you can try to make money. Our product is called NorthCoast Growth. It's a long-term growth strategy that invests in about 25 to 30 stocks. And that's when our market outlook model is strong. When our model is not strong, we scale to cash. We hold some cash. 1, markets change. Leadership in the stock market changes every 14 to 18 months. You have to be willing to refresh your portfolio. Will Rogers, I think, said if sometimes you can be on the right track, but you still get hit, the train comes, you don't switch out. It's the same thing. The market has rotation. And because of that, you have to go and rotate your portfolio. Second is, avoid losses. We scale to cash in bear markets. In my history of running the portfolio, we've held 100% cash 3 different times in the last 10 years. And I'll talk about how we do that. And then finally, no one knows the future. The only way to beat the market, I believe, is to systematically implement a common sense model and then get out of the way. So at my firm, we never sit around and talk about Obama, talk about Paris, talk about the dollar, talk about football. We talk about football. But we never talk about how it affects the portfolio. Because we believe, just like the computer program with the GPA and the SAT, smart models implemented consistently will win. So, 1, how do we approach the market? I'm going to take a little sip because that scotch is getting me. All right, how do we approach the market? We approach the market with a model. We measure 40 indicators. 40 indicators we measure every single day. Some are technical, like what's the price momentum, what's the volatility of the market. We measure sentiment. These are surveys. What are producers saying? What are loan officers saying? What are they saying about their business and their economy? We measure the macroeconomic picture. What are jobs like? What are leading economic indicators like? And the valuation. Where else can you put your money? Bonds, stocks, cash, real estate. Those are the big 4 assets. That's what you always have to concern yourself with. How exciting or how valuable are the other assets versus stocks? So we measure this and score this every day. They all have equal weight. What this does has been a very good bear market indicator. It's kept you out of trouble, kept our firm completely in cash. What we're trying to show here is when technicals and sentiment and macro and valuation are all lined up, this is our level of investment. 2000 to 2002, we held a lot of cash. 2007 to 2009, we held a lot of cash. Not because Dan, even though he lived next to a managing director at Lehman Brothers who ran collateralized mortgage obligations, was right next door. I had no idea Lehman was going bankrupt that weekend. He didn't know. No one knows. But what was happening at the time was valuation already told you kind of had a rich market and bonds were pretty attractive. Sentiment had rolled over. Every consumer confidence survey, producer confidence survey, and loan officer credit survey was in the dumps since the middle of 2007. And then finally technicals rolled over once bear went under. That's how we held so much cash. So we score the market every single day based on a simple model aggregating 40 metrics. And if you guys sat in a room for 15 minutes and I said, what makes for a good stock market? You guys would probably come up with the 40 indicators. Because you'd say inflation, you'd say earnings growth, you'd say good macro, you'd say all these things. This is all common sense stuff. But then you gotta let it work. So when that's our market exposure model. Here's 2007. In September, we were about 40 points in cash. Here were some indicators. You can see at the time, these are the different data points here. Basically, technicals were starting to weaken, but here's your sentiment surveys. All terrible. Macro, the one thing was still positive was some leading economic indicators. And valuation, you had the bond indicator, terrible. So it's kind of a mixed picture, but this is kind of where we sat. We sat about 50 points in cash. But then June 30 of 08, everything rolled over. So this is not a time for a portfolio manager to say, I'm smarter than the market. This time is different. This is a time for a portfolio manager to say, I'm going to follow a very simple model. And we did. So June, also getting back in is obviously important. By June 30 of 2009, we're about 85% invested again. And you can see there were a couple negatives, especially macro, because macro is kind of glacier. Macro kind of always tells you what kind of just happened, but it moves a little slower. That's what's holding us back, that 15 points in cash, but everything else is pretty positive. That's how you end up getting back in again. So August 26th, you guys were probably nervous. A lot of investors were nervous. China was in the dumps. People worried about slowdowns. One of our strongest readings, 86% invested. We put out a bulletin to all of our clients and said, look, I know you're anxious. Technicals are bad. Momentum, just measured by market technicals, it just broke. Everyone's very upset. This is the best time to invest. Why? Because other parts of the market were very positive. Other indicators were very positive. This is like driving a car. If you're driving a car on a Sunday morning in a nice car, you're driving 75, 80 miles an hour, no problem. As you begin changing variables, the quality of the car, you put some weather on the road, you reduce the quality of the driver, your brain reduces speed. Same thing's true here. We do have a little weather on the road. Technicals broke down a little bit. But everything else is pretty good. So, markets drop 10%. You don't necessarily have to wig out if everything else is in place. Macro's in place, valuation's in place. Market drops 10% like 1999 or 2008, then you have to be a little more worried. Where are we today? Today we basically sit 70% invested, 30 points in cash. The problem with this particular market right now is valuation is getting a little stretched, and there's not a lot of volume buying stocks, and the 200 days still will beat up. So right now we're about 70% invested, 30% in cash. We adjust this, we score the market every day. We don't jump around like, idiots back and forth, 70, 30, 20, something like that. It tends to move very gradual, as you saw in that opening chart. So that's how we predict market performance. We're looking at about 6 months ahead. When we have a position like that, it's a 6-month predictive model. Okay, that was heavy. Ha! Any questions you guys want to talk about with this?
So does each one of those have a 25% weight against them?
We equal weight these dimensions, and then there's some indicators that might carry a little more weight within the dimension.
And the sentiment, is that emotion?
All emotion, it's all surveys.
So you're kind of against emotion, but yet you have 25% of it in your portfolio.
And why? Because it's predictive. The way people feel about their businesses is very predictive. That's why. Also, one element of sentiment is measuring how did the market react to surprise news. So the jobs, what was expected, 200,000 jobs, 250 printed, how did the market react? That's a little bit of sentiment measure we're measuring it too. Everything we measure, everything we put in here is not accidental. It's because you do signal tests. You do hypothesis testing just like you did in stats class, junior year in probably college. Does this signal, when it go off, lead to a predictive answer? So,
How many we test, Dan?
350, 370 different signals.
Boiled down to about 40 in total.
Yeah.
Yep. Shoot.
Your interest rate. We have gone back and forth for the stock market to go up and down on the interest rate. And here we go again. Are we going, are we going not? It does have an effect on the stock market. Where do you think
Right.
this is going?
Interest rates.
Because we need to raise the interest rate,
Well, look,
I think.
I get it. Listen, that's like a 50-50. People talk about, you got the Fed presidents who argue about that very same thing.
Yes.
What I will tell you is, interest rates alone do not predict future performance. They're not tied. So, a lot of people when they read the headlines or read
It's
the
emotion.
Well, no, I'm just saying
Do you
that,
think?
do I think? I think interest rates play the discount rate, so certainly I care about where bonds price. Certainly I care about where cash is. One of the best things about this market right now is cash doesn't pay. You've taken the single biggest asset class and you've made it a non-issue. To me, that's a major, major floor on this market. Because anyone sitting in cash every single day says, oh my God, when am I going to do something with it? I'm losing to inflation every single day. When's my buy? When's my buy? When's my buy? So until I think other elements change a little bit and these other assets become more attractive, I don't care that much about interest rates. It's not a direct relationship. It's not cause-effect. So I
It's
just
only
don't
emotion,
care.
okay.
So when we buy, so first of all, that's model number one. Where's the market going? We measure 40 indicators and we adjust portfolios given those indications. Next step, you got to go buy stocks. How do you buy stocks? First of all, you look at traditional things. You buy current earnings, you look for institutional support, you look for technical momentum, you like management, not to be floating a lot of stock, things like that. Then you get back to past profitability, future profitability. Where are sell-side analysts putting the target on the stock? Things like that. You compare and incorporate all those numbers, and then you score and rank 3,000 stocks. So every day we score 3,000 stocks based on these factors. Then after that, what do? If we have open to buy or our market exposure models increasing, we go buy a stock. We buy a stock that has these characteristics. Why? Because these characteristics have led to future performance. If I take the market, these 3,000 stocks, and I break it into quintiles, stocks that have those characteristics consistently outperform the gray, which is the universe, or the lowest quintile, which is the gold. The market doesn't stumble around like a drunken monkey. People think that all the time, throw darts, all that crap. That's because first of all, their factors are bad, and then their time horizons are bad. The market consistently rewards stocks that generate earnings, they have good profit margins, they have institutions that are buying and supporting their stock. Those are the big three. Everything else tends not to matter. So if you're buying from that pond of stocks, you're putting yourself in a pretty good position to beat the market.
Question.
Shoot.
So, when you're talking about stocks that have these variables that are important, if they tend to go down, would it be a position that let's just hang on to them until they're going to go back up because we know that they are profitable
Great.
on the whole?
Great question. So I'm a quant. I try to fence these bucking broncos, these stocks, these 3,000 stocks like these big broncos out on the plain. I'm trying to fence them in with rules.
Yay, North Dakota.
Yay, North Dakota. If a horse or a stock breaks the rules and doesn't conform, we have sell stocks. Because stocks will do that to you. They won't conform. There was no black and white. There was a New Yorker cartoon about 15 years ago I cut out and I have it at my desk. It's a guy who pulls off the side of the road. He gets on the phone. There's a payphone there, which of course is funny nowadays. There's a payphone. He's on the payphone, and he says, "I don't care what your model says. Sell Acme." And of course, in the background, the Acme Pharmaceuticals on fire. The headquarters is on fire and blowing up. So for us, I know when I buy a stock that has these characteristics, I have a 65% chance to make money at a rate higher than the market. But if the stock's not conforming, we take a loss, we get out of it, move on to the next stock. Because any given day, I'm going to have 20 or 25 candidates that are good stocks to own right now. So I don't sit around and say, no, this is a great stock, let's own it, let's own it, let's own it. I don't care. The only kind of good stock to me, really, is one that's making money. So that's scoring stocks. I would say this is kind of how we look at it, guys. This is Disney. I just grabbed a stock that maybe you guys care about. We score 3,000. But what this is saying right now is Disney is a negative 1.5 essentially. So on a bell curve, if you guys remember stats, negative 1.5 is bad. That's in a bad group of stocks. That's in the lowest 10 or 15% stocks out there. What you're looking at here, here's the Z-score. This is the score of where Disney ranks versus all the other stocks. The last time it ranked this low was back when Disney traded at 120 and had that really terrible couple weeks. And now this little climb up, Disney is becoming a pretty good short again. So this is how we look at the market. And why is Disney a short? Valuation metrics are bad versus the market. Target price is kind of neutral. Balance sheet quality is not bad. Analyst sentiment's not bad. Ooh, but relative to other cable and media stocks, bad. Technicals mediocre. Short interest rising. Hedge funds getting short. These are all we're measuring. Then I don't sit around and say, oh, but I love Marvel Comics and they're coming out with the next Captain America. I don't sit around and talk like that. Stock has these characteristics. Those characteristics tend to lose. We get out of Disney or we sell short. Now the performance of the product, we've made, in the last 10 years, we've made 80% net of all fees. Market's made 77. But what's the key? The key is in a market like 2008, we're down 12 points net of all fees in a down 37 market. What this is doing, these blue lines here, is trying to show you what our cash position or investment position was every month in the last 10 years. And you can see in good markets, we're pretty fully invested. In some difficult markets, we've held a lot of cash. So, if I'm out there and I'm producing S&P-like returns with less than 1/3 the drawdowns, that means I'm generating alpha. This is the magic word for a money manager. This means for every unit of risk you're taking, how much return are you generating? And alpha above 1 is good. We've generated good alpha. Why? Because our capture ratio, we're getting S&P return and then some, and only about 2/3 the down. And that, my friends, is how I think you make money. First, you have to realize markets change. You can't sit in the same stock forever and think you're going to be okay. Sure, you might catch Microsoft in the 90s. You might catch an Amazon, maybe if Amazon's going to go to 3,000 now and be a $1.5 trillion market cap. That's all very possible, but it's unlikely. So you're playing a probability game when you're managing money. You're managing money based on probabilities. Second is you avoid big losses. You don't want to get stuck in a bear market. You dig yourself a 40% hole, you're not going to make money. And then finally, no one knows the future. Don't listen to the crap. If you find yourself listening to the crap, tape CNBC, watch it next week. 1 week later, and see what nonsense it is. Jim Cramer, Barron's did a great piece on him last year. All of his picks, they underperformed the market by 30%. He chronically lost money. They closed his hedge fund because he chronically lost money. Yet I have to answer a question almost every day about Jim Cramer and Alex Alcoa. Okay. So no one knows the future. Thank you so much. Great to be with you tonight. Happy to answer any question. Been managing money for 20 years. And happy to answer anything else you want to talk about. That's our approach to the stock market. Thank you. Any questions? Anybody? I'm done. So the scotch comes up. Yes, hi. Gary.
So you're down 8.5% this year.
We're no, that's September 30th. We're flat for the year now.
You're flat?
Yeah, that's September 30th. October was killing it. Yeah.
So you made up 8.5% since that time?
October was obviously a great month. The big thing about October is we didn't get scared out of the market.
Yeah.
Because August 26th, for people that are tactical and people that use cash as a hedge, that was a major inflection point. A lot of my competition ditched and got out of the market. So they logged it down 10 and then went to cash. That's because they're using market technicals alone to dictate their investment exposure. At the time, August 26th, you had other good indicators that were very positive. That's why we stayed long. That's why we got the whole bounce back. And then we had a few good stocks too. So we're flat. We're basically flat from there.
How often do you guys turn over your portfolio every year?
We average 1.7 times. So some people think, when they hear the story, they're going to say, wow, you turn over 3 times, 4 times, stuff like that. 1.7, very gradual. And we also try to book losses too, so we're trying to make it very tax efficient also. Yeah.
So you talk about needing to move in the market. That was your first point there.
Yep.
So if that's the case, how did the dead people do better than everybody else?
That's because they didn't identify the proper places to be. They rode through the storms. That's all.
So that's just a really long-term buy.
10-year, buy and hold. Yeah. And most people who are not dead do the wrong things at the wrong times. They crush performance. That Dow bar started with 8.2%. They lost more than half of the return per year by their changes.
Yeah.
Yep.
So then, the question becomes, your actions and your influence. You said you were talking about going into cash position, and yet dead people really do well, as my question knows, because it's a hold kind of thing.
Yep.
So, should the trustees who held that have gone into a cash position, or was it okay because stay the course?
I think any mandate that's over 25 plus years should be probably racing over to Vanguard and depositing their money. But the problem with that is no one lives with 25-year horizons. And the problem is the trust, maybe the kids need the money next year because of a divorce, because of an accident, because something like that. All of a sudden the market's down 20, I gotta take 5 points of principal out. And I've crushed my future performance going forward. So granted, if someone says, Dan, I have a 25-year horizon, I'd say, fine, don't worry about market exposure. Really don't. But any mandate that's below about 24 and below, I think you have to start being worried about it. Because you go back, you go back to some of these pockets in time.
You know what happens to all of us is, it's great to look at numbers, and we're showing you numbers right here because that's all we have to show you.
Correct.
But you don't care about what happened in the past when your money's put to work today. It's the funniest thing. We have people come in the office all day long. What they want to know about typically is performance and fees. That's it, right? And there's nothing wrong with that. That's all we have to go by, right? I mean, that's totally rational. But the minute you put your money to work, you could care less about the guy who did 10% a year for the last 10 years, the track record that you just bought into with the 1% management fee. You could, and in fact, when I remind you of it, and you're down 10% after 6 months, you're gonna be really irritated with me. Seriously. We're living life forward, but we're making decisions based on history. And that's kind of ironic, I think. I mean, it's really kind of funny.
And I totally agree with you. This presentation is amazing. You guys are terrific. For me, when I look at recommending clients to you, is there's I have some financial advisors for my clients who are saying things like with the recession, stay the course, and they ended up right where they, I guess, should have been. And I'm not a financial advisor, I'm a lawyer. And then others who have said, no, they should have done blank under California statute. So I find it interesting as I sit here, as you explain this to me, and I actually kind of understand it, but which one and how does the investor make that decision? Except for trusting you guys, and several of these people, a number of these people have said you guys are like the best and trustworthy and have an amazing amount of integrity. But from an objective viewpoint, it is, then what is the investor supposed to know to do? Stay the course, go to cash, invest in something?
Could you repeat the question?
So the question basically is, what the hell is an investor to do? In a nutshell. I will say this, and Brent can disagree with me, but I think any mandate for over 20 plus years, you're always buy and hold. You don't, because you're going to be close to the average. You might compound at 5 instead of 8, or because you might work through a bad pocket, but you're probably going to get a bad 20-year pocket. Means after inflation, you're going to make 4 to 4.5, 5 points. What's that? Once you get below that type of time frame, I think there's heavy risk of you sitting in a pocket that's not good, because this is just the return. You had 16 years where you lost 1.5% per year. You had 12 years where you made nothing. That's not as bad as the withdrawal rate. Because what happens is now you're taking 4 to 5 points out of a portfolio. Now you're saying, wow, this isn't 1.5, this is 6. Well, you know the rule of 72, 6 points goes into 17, you have no money. You don't live the average retirement, you live your retirement in your pocket. That's why a product like ours, I think, fits better into people's lives. Because sure, we might only get 90% of the upside of the S&P, but what matters is the declining pockets. This is what matters. Warren Buffett said it the best. The first rule of money management is not to lose money. The second rule is not to forget the first. This is how wealthy people make money. You make money and then you keep it. You can't give it back because it takes too long to make return.
I would like that. Do you have a chart with like market performance over time, like a
Not a
chart?
long one, that's all.
So the problem that I have with this chart is we look at this intellectually and we go, okay, it's whatever, it's 16 years. Do you have any idea what that feels like if that's really your money? There might be a person in this room, but it's a rare person that's going to hang out for 16 years and do negative 1.5. I mean, that is just, that's
You know the truth of what they're
unbelievable.
probably going to do?
I mean, in fact, they're
Make it
strange
worse.
if they do it.
They're going to make it worse because
Yeah.
they're going to get out of something and into something and out of something and into something. They're not going to get one.
Yeah, and I'm going to say something that's kind of off the beaten track a little bit. This isn't about, and Dan's company does a great job of managing money, but being successful over the long term isn't about picking the best money manager. It's about actually being there. It's like going to the gym. You know what the number one thing about being in shape is? Showing up. It's not what you do. It's not, do you circuit train? Do I do a lot of cardio? Do I lift heavy? What do I do? You gotta be there to get the performance. Seriously, I mean, it's life. We try to make it really complicated. It isn't that complicated. But this stuff, because we can trade it, we can say, no, I don't want to do it. Yes, I want to do it on a minute-by-minute basis. It gets tough. If you couldn't trade it, you'd probably do a lot better, as Dan's data indicates. It's about showing up. It's not about picking the best manager. It's not about the lowest fees. It's about actually friggin' being there. This is not an intellectual exercise. It's actually real life. And you also, to do that, you gotta think about what it's gonna feel like in advance when the bear market comes, when the 25, 30, 35, 40% down comes. You gotta think about this, because you know what? You know how you're gonna feel if you're normal? You're gonna be afraid and you're gonna wanna bail out. That's normal. So you have to condition yourself to say, this is my game plan, this is my routine. Exactly. You gotta do that, because, I mean, if you go, hey, I'm gonna play it by my gut, I already know what you're gonna do, you already know what you're gonna do, why even go there? Marjorie, did you have a question?
No, I wasn't even going to ask about inflation. You're not worried about it. We're just going to bypass that and go through it.
No, but
You're worried about inflation?
Are we, if we don't raise the interest rates, back to the interest rates, are we going to go away? Are you worried about inflation at all?
I worry, like all of you, about a shitload of stuff.
Well, I mean,
What I have to-
Technical term
But
for
what
it.
I have to be honest about
Yeah.
is my reading of the tea leaves doesn't help it out.
No, I understand that, so I'm not gonna go there, we're just gonna pass it. If we just don't raise the interest rates and we go into inflation, we're good, we go.
No, but I would tell you, John Hussman runs a big fund, run a big firm for a long time. He's a valuation guy. Market's been a value, that's all he talks about versus things. He's been in cash for 3 years. He missed 65%. There's debt guys who say, I can't believe the debt, the 13 trillion is growing every day, and how are we gonna pay it back, and interest rate? There's economist guys like that who get negative on the market, and they don't participate. They're
Where are
not
all the
on
gold people from 3-4 years ago?
Well, because our dollar's up, so
No,
gold
it's
goes
not.
down.
That's the
So
problem.
when our dollar's down, gold goes up.
It's not a cause-effect relationship. It's not linear. People talk about the market in a very linear.
We just had a
fashion.
terrorist attack in
That's
France
what,
and gold
nothing
went
happened to
down.
the stock market. No, we did
I
good.
mean, gold's supposed to be the store of value. It's supposed to be, the
Gold's
panic,
down,
the
though.
panic metal, right? It went down.
What I'll suggest to you is the market isn't just related to one factor. It's a number of things that are present. Let me move ahead. It's a number of things that are present. It's not just one thing. It's earnings growth. It's what other asset classes are available. It's, of course, it is economic. What's the Fed doing? There are inflation indicators in here. But the market swirls like this big tornado. And trying to predict that it's going to turn this way because one data point says it meant you can't look at it that way. It's not linear like that. It's more like chaos theory. So you can't look linearly like that. You have to, and you also have to be willing to accept that there's a loss factor in this. I'm going to be down 10% one time. We've been down 10% 2 or 3 times. The only way you can make a reasonable return on equity is to expose yourself to risk. That's what we're doing. We're exposing ourselves to risk. The way I think you can do it reasonably is with an approach like this, where it's model-based, because I promise you, model-based, simple actuarial models will outperform the human experts 9 out of 10 times. Well, how do I know that? Because I know it in my business. Because this data is no different in the 90s, the 80s, the 70s. People underperform the S&P 500 because they do what feels good today. So I love that stuff. I get passionate about politics. I am scared for inflation. I don't know how we're paying the debt. Yes, I hope we grow out of it. All those things. But managing the stock market right here, there's different factors you can look for that lead to future performance. That's all. Anything else? Yep.
I know I missed a little bit earlier, you talked a little bit about terrorism, but I spoke with my sister this morning. She doesn't normally get scared. She's terrified.
Right.
And when you're talking about fear and risk, if France will put very close to us, but if it happens in Times Square, what are people going to do? Are global markets going to change? Is there a real fear to work with?
Sure.
Well, I'll give you this analogy. So, if it happened in Times Square, it would be awful. It would be very tragic. We had something like that happen, 15 years ago, right here, and it had a dramatic effect on the markets. We weren't prepared for it per se, as much as you can prepare for something like that. Our markets were closed for the better part of 5 days, I believe, 4 or 5 days. And when they reopened, they dropped dramatically. In that month, I think we were down like 15% or so, and then we recovered from there. There's a big hit on our economy. The thing that we've witnessed, and this kind of goes back to what I was talking about, what do you do in the downturns? What do you experience? We as human beings, and because the markets are made up of human beings, and Dan's system allows him to measure, part of what he does is measure the emotion of human beings in the market and create probabilities that say, this is a better time to do something than not. We as human beings, once we've seen something once or twice or 3 times, we tend to have a less violent reaction to it. So not to marginalize death, if you will. But the first dead person you see bothers you a lot. The 10th person bothers you less. The 50th still bothers you, but you go on with your life. So I'll give you an example, real life example. 9/11, you know what the reaction was. It was a pretty violent reaction from a countrywide perspective. There were 4 bombs placed on FedEx planes in, I believe it was 2009 or 2010 in the Middle East. the market didn't react to it at all. If that had occurred a week after 9/11, all hell would have broken loose. And so people get more used to it. I mean, people who've lived in Israel for, they live there all day long, they do just fine, and they're used to these kinds of incidents on a very regular basis. And they survive and they prosper because we as human beings are programmed to do that. That's what you do. So I'm asked this a lot. I mean, what if a dirty bomb? What if this? What if that? That's not going to be what takes us down. If anything, it'll make us fight harder. What's going to take us down is a crisis of confidence. Not unlike 2008. That's a real scary situation in my opinion. Where people are seriously considering, they're lining up, seriously considering pulling all their stuff out. If people line up and start to pull all their stuff out, guess what? We're done. Because this is, whether you want to acknowledge it or not, this is a Ponzi scheme. The financial market, the world is built on not everyone needing all their stuff at once. There's leverage involved. That's the biggest fear, that's the biggest danger out there. And that's why we had such a violent reaction in 2008. That's why TARP came into play. And whatever you think of it, I don't care. It's just, that's why all those things were done. That's why the people that you wouldn't think would do that did it. Because they were afraid of everyone asking for their stuff back. Because when everyone asks for their stuff back, then the guy selling shoes doesn't have any money to finance his inventory for that month. And guess what? His business is done.
It's called a run on the bank.
You got it. You got it. Doesn't matter how good you are at that point. It's over.
And I think that's what you're saying to all of us, is that you will keep a level head, perhaps when the rest are in panic.
Well, what I'm saying is that I will allow data to drive my decision-making process. So, in 2001, a bomb goes off, but we're coming from a very highly valued market with a slowing down economy, joblessness going up. That's a different scenario than other markets. If a bomb goes off, yes, it's going to be terrible, but at the end of the day, if inflation is low, earnings are good, there's no other assets to put money in, it's going to be a pre-snapback. I think Paris didn't have the impact that maybe we thought it should. A lot to do because things are pretty good. But in this situation, we were already 50% in cash by the end of 2000. Not because we had any idea about a terrorist action, but because things warranted. Valuation was high.
P's were 35 or 40 in S&P.
But
Prior to that.
and forgive me guys, I'm sort of there, but the financial crisis of Greece, when then you look at a global economy and how that may affect things, or what's happening in China, or you've got to have more than a bigger perspective, which
Absolutely, these are 10% trap doors. Greece, this is China. The China slowdown took the market down in 3.5 weeks, almost 11 points. Those are trap doors. Those are people who have Homer brains who run for the exits. All I'm saying is there's time to raise cash. There are times to get out of the market, but it's not just because prices are down. Prices will drop a lot. There'll be 5 and 10% corrections every single year. The key is, can you differentiate between a trap door where everything else is pretty good and one where, you know what, we're 50 points in cash, we're on our way to 100 points in cash because everything was rolling over. There was no good days. So for me, obviously a terrorist attack would be terrible, but I believe the market does reflect common sense economics over time. So if inflation is low and earnings are good, and other assets aren't yielding much, I think the market will do okay.